Early retirement can be an ambitious financial goal, but with the right plan in place, you can reach it. Here's a 7-step course of action that can help you determine if early retirement is possible and what you'll need to do to make it happen. Welcome back to another episode of Living Fire. If you never want to miss an upload, make sure to subscribe to the channel. Number 1, determine how much income you'll need in retirement. Many people, incorrectly, start their retirement planning by coming up with a number. You'll often hear statements like, if I can get to $1 million in my investment accounts, I'll be able to retire. But this logic is faulty, and here's why. It's not about how much money you have in the bank. It's about how much sustainable income you can create from the money and other retirement income sources at your disposal. For example, to achieve the same standard of living, someone who will receive $5,000 per month between pensions and Social Security won't need to save nearly as much as someone whose only fixed income source is a $1,500 Social Security benefit. The standard rule of thumb is that you'll need about 80% of your pre-retirement income to maintain the same standard of living. According to this rule, someone with a $100,000 salary would need about $80,000 in annual income after they retire. This can be adjusted higher or lower, depending on your circumstances, and it may be a smart idea to consult with a financial planner to help with this step. If you plan to travel extensively or pursue expensive hobbies after retiring, you may want to aim for a higher level of income. Conversely, if you plan to live a simpler life in retirement, you may be able to get by with significantly less. Number 2, figure out how much will come from Social Security and other fixed sources. Without getting too far into the weeds about how Social Security works, the first thing you should do when you have an income goal in mind is consider how much of it is going to come from fixed, reliable sources. Now, if you plan to retire years before you're eligible for Social Security, it's probably best to leave that out of your early retirement calculations. However, if you have any pensions or annuities that will kick in right away after you retire, they should certainly be taken into account here. As an example, let's say that in step 1, you determined you'll need $60,000 per year in annual income after retirement, or $5,000 per month. If you can count on a $2,000 monthly pension, this means that you'll need to create an income stream of only $3,000 from your savings. Number 3, calculate your number. Here's the step where you determine your savings target. Take the amount of income you'll need to produce from your savings. Then decide how much you can safely withdraw from your retirement savings in perpetuity. Most retirement planners use some variation of the 4% rule. This essentially says that you can withdraw 4% of your savings during your first year of retirement and can adjust this amount upward for cost of living increases in subsequent years without much fear of running out of money. This rule isn't perfect, but it's a good starting point. Calculating the 4% rule is rather easy. Simply take your annual retirement income needs from savings that you calculated in the previous step and multiply by 25. For example, if you need $3,000 per month from your savings, $36,000 per year, multiplying by 25 gives you a target retirement savings goal of $900,000. Number 4, take stock of where you stand. The next step is to conduct an honest assessment of where you stand and how feasible early retirement might be. If you're 45 and want to retire at 55, but have a $20,000 retirement savings balance, you may have a tough time building up your savings to a desirable level. On the other hand, if you need $900,000 in savings to retire in 10 years and you already have $500,000, you might be in pretty decent shape. Number 5, make a savings and investment plan. Here's the step where an experienced financial advisor, such as a certified financial planner, really adds value. Obviously, if you determined a savings target and you've already achieved it, you're in good financial shape to retire early. On the other hand, a financial advisor can help you determine, among other things, how much you should save and invest each month to reach your goal and whether your investment strategy is too risky or too conservative. A financial advisor can tell you if your current income will be enough to save, or if you may want to consider taking on a side hustle to boost your savings. Number 6, account for healthcare and other concerns. Here's one thing that many people who dream of early retirement fail to consider. What happens next? How will you spend your time after you retire? Will you get a part-time job, pursue a hobby, travel the world? There are far too many possibilities to mention all of them here. But the point is that not having a plan is one of the most common reasons people end up regretting their early retirement. It's also important to have a plan when it comes to healthcare. If you aren't familiar, the age of eligibility for Medicare is 65, regardless of when you retire or claim Social Security. You may be fortunate enough to have a job that will let you keep your current health plan after retirement. Many public sector jobs in particular allow this. But if not, you need to plan where your health insurance will come from and how you're going to pay for it. Number 7, stick to the plan. Finally, if your goal is to retire early, it's important not only to develop goals and a course of action, but also to stick with your plan. One suggestion is to make your savings and investment plan automatic. For example, if you and your financial planner determine that you should save $500 per month in your brokerage account, set up an automatic transfer to make sure it actually happens every month. Early retirement is certainly an ambitious financial goal, but it can be far easier with the proper planning. These steps can get you well on your way toward financial freedom years before the average American leaves the workforce. Here are ways you can boost your Social Security outcome. Number 1, boost your payout. The amount of your Social Security payments depends on your earnings history and the age you sign up for benefits. Number 2, work for at least 35 years. Social Security benefits are calculated based on the 35 years in which you earn the most. If you don't work for at least 35 years, zeros are factored into the calculation, which decreases your payout. Number 3, earn more. Increasing your income by asking for a raise or earning income from a side job will increase the amount you receive from Social Security in retirement. Earnings of up to $132,900 in 2019 were recorded. Number 4, work until your full retirement age. You need to claim Social Security at your full retirement age, which is 66 or 67 for most current workers, to get your full payments. Monthly payments are permanently reduced for people who sign up for Social Security before their full retirement age. Number 5, delay claiming until age 70. After your full retirement age, payments will increase by about 8% for each year you delay claiming Social Security up until age 70. After age 70, there is no additional benefit for waiting to sign up for Social Security. Number 6, claim spousal payments. Spouses may claim benefits based on their own work record or up to 50% of the higher earner's benefit, whichever is higher. If you are married for at least 10 years, you can also claim Social Security benefits based on an ex-spouse's work record. Number 7, include family. If you have dependent children under age 19, you may be able to secure additional Social Security payments for them, worth up to 1/2 of your full retirement benefit to certain annual limits. Number 8, don't earn too much in retirement. Social Security beneficiaries under their full retirement age who earn more than $17,640 in 2019 will have $1 withheld for every $2 they earn above the limit. The year you turn your full retirement age, the earnings limit jumps to $46,920, and the penalty decreases to $1 withheld for every $3 earned above the limit. Number 9, minimize Social Security taxes. If the sum of your adjusted gross income, non-taxable interest, and half of your Social Security benefit is more than $25,000 for individuals and $32,000 for couples, up to 50% of your Social Security benefit could be taxable. If these income sources top $34,000 or $44,000 for couples, income tax could be due on as much as 85% of your Social Security benefit. Number 10, maximize survivor's benefits. When one member of a married couple dies, the surviving spouse can inherit the deceased spouse's benefit payment if it's more than his or her current benefit. Retirees can boost the amount the surviving spouse will receive by delaying claiming Social Security. And with that, we've reached the end of this episode, all about how to retire early. Are you saving for an early retirement? Get involved and let us know in the comments section down below. If you enjoyed this one and found it helpful, remember to leave a like on the video and to subscribe to Living Fire for even more amazing videos just like this one. Thank you for watching, and we'll see you in the next one.